This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com, and I have with me this morning a couple of noted and well-recognized writers on the web. No stranger to our regular listeners is Charles Hugh Smith, author and publisher of the website of2minds.com. Also joining us today for the second time is Lance Roberts from Houston, whose investment strategies and knowledge have been featured on CNBC, Fox Business News, as well as being quoted fairly regularly by a litany of publications. Welcome, everyone.
Thank you. Good morning.
Good morning.
Good morning, Gordon.
We will continue from session 1, already in progress.
I wanted to start with Gordon's chart of the last 15 years of the S&P 500, which shows what we call technically a megaphone top, which is higher highs and lower lows. And I think that this is an important context when we talk about Dow 20,000, because it looks like we're in an era where we could go to Dow 20,000, but it could be followed by a fall to Dow 5,000 in short order. In other words, we're living in a very volatile time with huge swings in asset class valuations. So that's kind of the context. It's not a buy and hold environment. And I think this slide really hammers that home. My first slide is of corporate earnings and corporate debt. And companies have been increasing their debt faster than their earnings. And I think this reflects on the overall economy, but it really goes to the heart of the argument for a legitimate Dow 20,000, meaning companies are earning so much money that the stocks are worth more. And for that to happen, you have to see earnings rise faster than debt. And I think that if you don't have that, then you can't get a legitimate Dow 20,000, because your earnings are basically a function of debt rising faster than earnings. And this is, we've talked about this on the show. It's like debt saturation, and diminishing returns, that as the whole economy depends on ever increasing amounts of debt for its growth, eventually the returns on adding more debt decline. And so this is, not the path to higher earnings and, higher sales, depending on debt. My next slide is, a slide of full-time employment and Social Security beneficiaries. And we notice that full-time employment is basically back to the same level of 1999, 2000. It has not kept pace with economic growth or population growth. But the Social Security beneficiaries, that number continues to rise by over 12 million. From the late 90s. And so what this slide suggests is that we're entering a period where taxes are going to have to go up to fund the retirement of the baby boomers, and or benefits will have to go down, or some combination of those. Either way, that means households are going to take a hit in terms of their disposable income. And so in a consumer-based economy like America's, you have to ask, how can we get more sales and more growth at the corporate level if household incomes are going to be declining in terms of disposable income and purchasing power? And then my third slide is a look at the foundation of all economic growth and financial profits, which is output per person, or productivity. And so you can see that going back about 20-some years from 1990, we've had a 58% increase in productivity, which is the foundation of our prosperity. And that's a substantial rise. But when we look at other things such as government spending up 300%, the stock market, more than doubled from 2009, a lot of these financial indicators have completely jumped the shark. They're so far above this productivity increase that they're really they're at an extreme risk of a Wile E. Coyote moment where all these financial indicators have run off the cliff. They're so far extended above the foundation of our prosperity, which is an increase in productivity. So these are the things that we would need to see increase legitimately to get to Dow 20,000 based on increasing earnings and profits. And if we don't see these, then we're not going to reach Dow 20,000 on a legitimate basis.
Yeah, of course, then we get into whether on a nominal basis or a real basis and what the currency is denominated in, right, too, Charles?
Yes, that's right.
And these are not small points. And it's so easy to look at charts we see every day and report it on the Dow, and it's in nominal terms. But what is it in real terms, adjusting for real inflation, and what is it based on the currency that you're holding it in as it's being debased? So everything gets very complicated in answering that question. I've got some charts. Let me take a stab at it myself. Let me just revisit that first chart we had up earlier, this megaphone top, and you can see that we're going parabolic here. There's almost no question. Back to your point, Lance, we've got the three phases, and I agree very much. I would label them in the classic sense as, usually the first phase, you got the smart money gets in. Phase 2 is when the professionals, fund managers, etc. get in, and phase 3 is when the public gets in. The public has not arrived at all in this particular run-up, and as you correctly point out, Lance, they've been kind of waiting and sitting on the sideline, the rally that's been hated. Whether they'll get in at some point, I don't think it'll be because they believe there's such a great opportunity. I believe they're going to, if they get in, it's out of fear of what's happening and how they can protect their assets or protect their money, and whether they choose to make that in the equity market, time will tell. I have a little different perspective here. Maybe because I spend so much time at the macro level on a global basis. And the analogy is the Weimar Republic in Germany. We all know the story of the hyperinflation that we had in Germany because of the magnitude of war debt that it had from the First World War that we had saddled them with. And what that forced them to do is print the money. What did the Weimar Republic was the national global holder of the reserve currency? What would have been different when Germany started printing the money if that money was the global reserve currency? The second question we wonder what would be different is what if all the other currencies in the world weren't pegged to gold as they were back then, and they all had their own fiat currencies? What would have been different in Germany? Would it have went on much longer? Would we have had the same run-up? And that's where you have to start peeling this onion apart to understand whether we're going to see this Dow 20,000 or Dow 5,000 or both. And maybe, guys, maybe the investment is to bet on volatility, maybe not on stocks and equities. But this is a chart that I like in looking at the recent emerging markets problem. And I call it the von Mises crack-up boom. It can be very complex. But if you were to, and I did a show with Pi Andros on hyperinflation. We did a number of them in the library. And we showed there's been 52 documented examples of hyperinflation. And what they are is they're first and foremost a currency event. They're not about inflation running rampant. Yes, that happens, but it's because of the debasement of the currency. So when you start to get governments with debt, the only way out is the debasement of the currency. So what's that mean? Well, what happens is they traditionally go through a series of steps, and I've got them listed here on the chart, from inflation, where actually you start to see them hide inflation because they're trying to grow credited money as a substitute for wealth and to cover the debt. And we've talked about that fairly extensively, right, Charles, of the games that's been going on in inflation, but you see them around the world. Then it leads to something called financial repression, where the government is forced to drive to negative real rates, exactly what we've had here in the States, and on a global basis. Then you start to see things such as hoarding and precious metals and interest in precious metals. We're seeing that now to varying degrees, maybe not as much in the United States, but in places like India and Asian countries where they can't grab it fast enough. Then you get into reduction in personal freedoms. you get into a devaluation in the currency, then you get more centralized government control and statism. And this is a long discussion, but suffice it to say that countries are at different levels around the world as they're all grappling with this hyperinflation that we really began. And by hyperinflation, that is this rapid printing and expansion of the central bank balance sheets and pushing out liquidity that Lance mentioned. I have up this chart, second chart, that's simply a conceptual representation of kind of what's been going on. And you can see since in the bottom left, when we came off the gold standard in 1971, and this is not about gold. This is about taking the shackles off government having to create sound money and giving them the opportunity to use credit as a substitute for real growth. And it starts slowly, and you can see we got into securitization and eventually led to the whole fiasco with Fannie Mae and the housing. We then saw the expansion of various techniques to grow a shadow banking system, a structured investment vehicle, special purpose, and all of these off-balance entities that allow you to hide debt or take on more debt. And so it's allowed this tremendous expansion as we've pushed up. So what's it mean? It means that I believe right now we're up in that red zone. Are we at the top? No, we're not. We've got more to go. And what more to go means that in nominal terms, markets will continue to go up. But that doesn't mean, as you can see in the bottom left, the CDE, that I don't think we've got a serious kind of correction and scare, as you always see, as we go up in this red line I'm showing as this solid line. It's not going to be that way at all. There's going to be heavy volatility in it, but it's going to continue to climb. And one of the reasons I believe it will continue to climb is that around the world, I show Venezuela here, Argentina, the faulty five in the BRIC countries, Brazil, India, South Africa. We're seeing issues in Indonesia, Turkey, etc. These countries who are being saddled with the Fed's problem of printing money, not just the Feds, the Japan, Abenomics, the UK, and in Europe are expanding their money supply and having to offset the kinds of inflation pressures that they have, but they're not being able to offset them. What happens is the money starts to flee these countries as it has problems. And we saw that again in this emerging market. When it flees, it has to go somewhere. And where it goes is to the perceived safety. And right now, the United States, as bad as it is, it's the least ugly at the dance. And I believe the United States currency will be the last to fail. And so the money keeps flowing around, and every time it gets worse, it flows back to some degree back into the developed world, and more so into the United States. But it's like a ladder, you know, those fire ladders they have where you bring up the ladder behind you as it rises up. So as the U.S. comes up and gets worse and worse, there's fewer and fewer places to escape to. And at some point, we have to adjust markets because of the degree of malinvestment and mispricing. New investment won't come in. And so we've had some deleveraging, but not the deleveraging that we're yet to see. And that's when the assets prices begin to crash in nominal terms. And I believe we have some more run-up to go before that actually happens. And that's really in the Lance in your wave 3, where people are going to look to hide. In the Weimar Republic, what they did is they flooded to food. You know, the joke of leaving somebody going to buy bread with a barrel of money, and they came out with the bread, but the barrel was gone. The money was still there, because it'll be, where can I protect my assets? And I think to some degree the stock markets will be perceived as one of those temporarily, and I'm talking very temporarily, in that last little scramble for safety. Now, just to kind of wrap up, I've got a couple diagrams I'll show you where we are right now, but it doesn't stop, when I said a scare, a very major pullback before we lift up to a new high, or maybe it'll just simply test the high. Depends on how you want to measure this. On the Dow, in nominal terms, the SOX in Europe, and every chart around the world has a slightly different pattern to it. If they're going to see a lift that I'm talking about, there's going to have to be a globalized, concentrated central bank set of actions, almost like Abenomics in Japan becomes a global policy. And in a coordinated fashion, the central banks themselves they've already been in a coordinated manner printing money, no question about that, but in a lot more forceful manner. That'll be your sign that that's the end. That's the last shot. And I still think that's yet to come. If we're not, then we're going to fail pretty soon because clearly all of the economics are falling off dramatically. Earnings are completely disconnected from reality. And then we'll go into a deflationary bust. As the markets crash, there will be investment allowed to come back in and the cycle will be allowed to work properly because capitalism works. It's just that we are not allowing it to work. Comments, guys?
I would just kind of wrap up by saying we're really here in unprecedented territory, and I think that both Lance and Gordon's presentations give context to that idea. That the idea that the central banks can push and push and push assets ever higher with no retrace and no unintended consequences. I don't think that's likely, but it's so unprecedented that it's very difficult to predict when we finally get a collapse of this dependence on credit for growth.
Charles, I'll just make one comment here. The reason it's going to collapse and has to collapse is the debt is all based on collateral, and there's such a lack of collateral, high quality, and the collateral itself is being debased. And that's like a margin call on a global basis. It's one of the issues of the taper. The government is such a dominant part now, over 30% of the debt market, that there's insufficient collateral growth to allow credit to expand because they're gobbling up what is considered risk-free. And why that collateral is also failing is so much of its malinvestment. The non-performing loan levels themselves are increasing. They're being hidden, but they're just not producing. And as the economies around the world are slowing, and they are slowing, you're seeing the EBITDAs and the free cash flow, which is a true measure of wealth in all of the Fortune 500 companies, deteriorating extremely rapidly. So when is that going to finally collapse? Well, we don't know, but I do know this. Printing the money is not printing collateral. That's the problem. Lance?
Yeah, I was going to say just a couple of things that, kind of my point here is that, to Charles' point is that, we go back in history. And, we say that this is unprecedented. What we're doing right now is unprecedented. And this particular type of monetary stimulus is indeed unprecedented to this magnitude. We've done this type of thing before, but never to this magnitude. But governments throughout history, we can go back to England and the South Sea bubble when the government was fighting the war with France, and in order to try to resolve some of their, basically the fact they were bankrupt, they sold government debt off to the South Sea Corporation, who turned it into annuity that they sold to individuals. It was just another way to basically another sham scheme to kind of refinance, restructure, make the debt problem disappear miraculously and to solve a problem in the short term. It always ends up badly because you have to deal with the structural imbalances. And the longer that we refuse to deal with the structural imbalances economically, it only makes the end game that much worse. I was listening to this morning a gentleman talking about the fact, in reference to the Affordable Care Act that has recently been, kind of started here as the exchanges have gone live, saying, well, Reagan eventually accepted Medicare, and that hasn't turned out to be a disaster as it was originally predicted to be. Well, it's a $40 trillion unfunded liability. The fact that it just hasn't been a disaster yet doesn't mean that it's not going to be, because it's broke. And eventually it is going to be a huge disaster. It just depends on which generation has to pick up the tab for it. But this is the short-sightedness of the way that we run our governments and the way that we view the financial markets and the way that we view our lives. It's only important if it affects me right now. And it's what I call the entitlement generation. We've all become entitled to what we think is good for me, but we really don't pay attention to what's good for the long-term dynamics of what we're leaving our children and the next generation after that. The second point, though, is that while we talk about Dow 20,000, I think it's great, and that we can talk about Dow 20,000. And, of course, if you try to talk about the fact that the market goes to Dow 5,000, you're immediately labeled a perma bear, and you don't know what you're talking about, and you're wrong, and because the markets are going up, so obviously you're wrong. It's important to remember that market reversions are healthy. To have a long-term successful investment market, you need to have a market that both goes up and down. The reversions in the markets are simply resets to get rid of the excesses that are created in the system from when the previous advance occurred. We view corrections in the market as a bad thing. And this is one of the big problems with the media. If you watch television and the market's up, 5 points for the day, they go, "Oh, the market was up today." If it's up 20 points, the market surged today. But if the market's down 10 points or 20 points, the market plunged, the market crashed, the market's horrible. Instead, they should be announcing, "Hey, the market's down 50 points today. The market got cheaper. Valuations are cheaper today than they were yesterday." See, we look at things absolutely backwards as investors as to what we should be looking at. We shouldn't be looking and promoting things as they go higher as being a good thing. It's because we're increasing risk. As investors, we need to be looking at the ideas of when valuations and when things are good investment opportunities for our dollars long term.
We have 75 million baby boomers about to retire. We have at least $82 trillion of unfunded liabilities that are associated with Medicare, Medicaid, Social Security. There's no way out of this. Forget the $16 trillion debt ceiling. There's no way out of this without the government defaulting on obligations to the citizens, which I doubt will do. The only way out is for them to print the money, hand it to the citizens. The question is, what will that money buy? So if the Dow goes up because of this concerted global Abenomics kinds of possibilities that begins, remember that when you sell your stocks at Dow 20,000, you probably are going to be lucky to buy very much with the outcomes from the value of those stocks in U.S. dollars. So, it's a really funny game that we're playing here when I talk about real, nominal, and the currencies. So,
exactly.
Do you really care if the Dow goes to 20,000? It's what's the real value in absolute terms of your money here. Any closing comments, guys? Charles, can we start with you?
I just would say I really enjoyed this discussion. I think we covered a huge amount of territory for people to think about, and my simple conclusion would be you can't just rely on nominal anything anymore.
Isn't that the truth? Exactly. The question is, what is real?
but Charles, nominal is so much more fun than real.
Good point.
Yeah, my closing comment is simply, and I absolutely agree with Charles' sentiment. It's always a great conversation with both of you. It's a great way to kind of stretch our imaginations and our thought processes. And as I started out by saying, is that the important thing for any individual is to make sure that we're not falling into a confirmation bias and only looking at things that support our own viewpoints, but stretch our limits of thought to incorporate the other side of the argument, because by doing that, and by being analytical about it, and by viewing both sides of every argument, we can make much better decisions in the long term for ourselves.
Let me close by echoing what I said earlier. None of these discussions are meant as trading advice. They're meant as just a discussion, and always consult a professional investment advisor before making any investment decisions. Thank you very much, guys. Enjoyed the conversation. Always a lot of fun. And we got to do this again, either when we're at Dow 20,000 or Dow 5,000.
Okay.
Because that may be sooner than any of us can imagine. But it will be a great ride, that's for sure. Talk to you again.
Absolutely. Thank you.
Bye.
Okay, bye.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.